Scott Groves here with another mortgage mystery. Why does the lender care whether you're going to be living in the property that they're financing, or why do they care if the property is going to be owner occupied? So we've got to answer this question and think globally about the risk of being a lender. So let's say, for example, you're the buyer and we're the lender, and we're lending you money to buy a property. Now, presumably, if we're lending you money on your mortgage to buy an owner-occupied property, meaning that's the property that you're going to live in and raise your family and put a roof over your head, we consider that as a lender to have less risk than if you're buying a second home or buying an investment property. And it goes something like this. Let's say, for example, you're a buyer and you own an owner-occupied home. You own a second home or a small vacation home out in the desert, up in the mountains, down by the beach, or you own an investment property. All of a sudden, unfortunately, you fall on financial hardship. The argument or the thought process for the lender is, well, you're probably going to default on the mortgage or walk away from the property or stop paying your mortgage payment on the second home or the rental property long before you stop paying your mortgage on your primary residence. When push comes to shove, and this has been shown historically over the last 100 years that they've been tracking mortgage data and foreclosure rates, that if somebody owns multiple properties, they're going to default and they're going to allow the rental property or the second home to fall into foreclosure or disrepair or back taxes or not pay their insurance premium long before they do those things on their owner-occupied house. So your owner-occupied house, the place where you're going to live, you're going to get a better interest rate. You can purchase it with a lower down payment. And the underwriting criteria is much more forgiving and advantageous for getting into an owner-occupied house. Once you go to buy a second home or an investment property, the rates can be higher, the down payment requirements can be higher, and the underwriting guidelines can be a little bit more stringent. But of course, this makes sense because to the lender, there's more risk. So if there's more risk to the lender, they want to be compensated on a risk-adjusted premium, aka the interest rate. So the interest rate might be higher, and they probably want you to have a little bit more skin in the game with a larger down payment. And that's why the lender is going to do all of their due diligence to find out whether or not you're planning to owner-occupy the property or whether it's logistically going to be a second home or an investment property for you. So if you're thinking about buying an owner-occupied property or a second home or an investment property, our team would really love to help. We put out these mortgage mystery videos to help educate our future potential buyers and our realtor community, but that doesn't mean that we don't want to do your purchase or refinance loan. So give us a call, get on our calendar, shoot us an email. All the links to get in touch with our team are below. We'll have somebody reach out to you within 24 hours. And if for some reason you're looking to buy or refinance an investment property, a second home, or an owner-occupied property in a state where we're not currently licensed, no problem. We've got an amazing database of realtors and lenders who work in local areas in all 50 states, and we can refer you to the right person. Scott Groves with Mortgage Mysteries. If you have any questions about occupancy, feel free to leave a comment or shoot us an email. Talk soon.